Yeah, so the precious metal space, and this is same with the equities market, is they do have short-term mixed signals. So when we look at this 150-day moving average, this thick moving average, and along with these other moving averages, they're sloping upwards. They're trending up. So the long-term trend remains up. That's a great way to get a gauge. Is price, long term, is it still in an uptrend and rising, or is it in a downtrend? So the precious metals is the same with gold and silver and platinum and palladium. They are in a long-term uptrend. The wild card here is the extreme volatility that we had. It did quite a bit of damage to the chart, and now the charts are trying to figure out what they're going to do. We are seeing gold continue to move higher, and it's back up to around 5,200, which was kind of a Fibonacci measured move, a target that we had a long time ago. And so now we're back up into this key resistance area, and we need to see how the market is going to react. So long-term trend, it's up. Short-term trend, it is, when we look at it from a candlestick pattern or a chart pattern, this big red bar coming down, price action is drifting, is working its way up. These are called inside bars, and it can actually be seen as a bearish sign. So price will work its way up, and it can get right up to the upper end, and then boom, you can have another big bout of selling, and it can bring it right down, and then it can start to go lower. And so that's the big question. We saw huge volatility, massive volume surge, and of course it was also, I think one of the key things here is it was a lot of sentiment, right? The air was so thick you could cut it with a knife with people wanting to get into precious metals. And when the sentiment is that thick, you also have very big price reaction, which is what we saw. And so that's the big wild card. Not only is this candlestick chart pattern a little bearish, meaning, gold's got to prove itself here. Same with silver. Before I get wanting to get long and get bullish, but the sentiment is a warning sign that it could potentially be a significant standout high. And let's just take a look at the long-term chart here. If we zoom out a bit, you'll see how gold has a series of rallies, and then it pauses for several months, has a big rally, pauses for several months, has a big rally. And so now I think we need to see the precious metal space work itself out. It can come up, it can trade sideways. It could go sideways for a few months here, and it can still keep moving higher. And if it builds a strong chart pattern and the volume and everything is in line, then we could have another big move, and it could easily run. The next target after this is about $6,100 for gold. So gold and silver have these chart patterns that they need to just kind of build a new launch pad and build some confidence that this isn't just going to get stepped on with another big bout of selling here any day now. Yeah, we're kind of letting it build a new launch pad. I don't have a problem buying back in potentially at a higher price, but I want to make sure I'm buying in when we have a big move. For example, we take advantage of gold over here. We got in right over here and we caught this move up. We also got in right over here as it started to break out. We caught this move up. And so now gold can do its thing. And if it is going to pop and break out, we might take another stab at another big parabolic rally to the upside. But right now, we locked in some of our gains right up here at around 5,300. We sold a bunch of our silver at 113, and we've since then closed the rest of our position out. So we're waiting now for just the precious metal space to build a bullish chart pattern and then start to break out. And when we have confirmation, we can get back in and hopefully catch another, multi-month rally in price.
Gold has climbed back toward major resistance levels after its latest surge, approaching areas technicians previously identified as measured targets. When markets return to these zones, reactions matter. Will buyers push through decisively, or will sellers defend prior highs? Recent candlestick formations suggest hesitation. After a large downward move, price has been forming tight consolidation bars, often signaling potential weakness. This pattern can resolve in either direction, but historically it sometimes precedes renewed selling. Volume spikes and extreme volatility earlier this year reflect emotional trading. Now the metal must prove strength through sustained breakout action rather than enthusiasm alone.
I think that's the general consensus. The price of gold and silver are what they're at right now. The mining stocks, seem to be undervalued. They've had some pretty big moves, and they are performing fairly well at the moment. They obviously had a big sharp pullback. Right now, I mean, they're still in a long-term uptrend, and they're just like gold. They're pushing up into resistance where they got sold off into last time, and so we just need to see how they go. I think, the precious metal space is all the same trade. It really is. You either trade gold, silver, or miners, or you have a combination of them all. They almost all go up and down together. So they're all the same trade. It's just some of them might outperform more than the others. And so that's why I think a lot of people diversify, right? They'll have silver, they'll have gold and miners, but the miners are performing well. I mean, obviously silver is, we'll look at the chart of silver in a minute, but silver is way down here floundering and really struggling to catch a bid, whereas gold and miners are already up near previous highs, showing they're more resilient. And that's the way I think gold is kind of always like that. People are nervous, they naturally flock to gold, and because it's more stable and it's a bit more of a defensive play than silver. Silver definitely has a more speculative angle to it. And so gold miners are also benefiting from that. People are getting into the large cap gold miners. They're really liking I think the valuation standpoint, as you just mentioned, fundamentally at these high pricing for metals, the miners are undervalued still.
History offers perspective. In 2011, silver staged a dramatic rally, followed by a steep correction exceeding 30%. Afterward, prices drifted upward briefly before entering a prolonged downturn lasting nearly a decade. Today's setup carries visual similarities: rapid ascent, sharp pullback, and cautious recovery. That doesn't guarantee repetition, but markets often rhyme. Gold, too, experienced years of consolidation after its 2011 peak before resuming a durable advance. Investors must consider whether current conditions represent another launching platform or a temporary high before extended digestion. Patience becomes critical when markets approach historically significant turning points.
Yeah. When we look at oil, it's pretty clearly still in a downtrend now. It's a huge volatile downtrend. Usually there's some type of news or just a short-term rally that brings things up to the upper end of the range. I think oil could still pop and potentially run up to around $72, $73. I think this chart pattern is still pointing to potentially one more leg higher, but I think we're still in a downtrend. I think it could easily, unless there's like some crazy war that breaks out and it totally changes the game. This is a reaction high, meaning the trend is down, but you're going to have some of these counter trend moves take place temporarily. Eventually sellers step back in and pull it down. But I think we're seeing oil trade higher. We're seeing the oil holders, like energy stocks in general, they're trading at all-time highs and keep pushing higher. So it's the stock side of things is really good. The commodities themselves, oil's in a long-term downtrend, but short-term, I think it could go a little bit higher. And if we look at natural gas, it's had a huge spike. It's come right back down. And, to me, natural gas is pretty neutral here. It's a volatile one to trade. And I would just I more or less ignore it. I don't pay too much attention to natural gas simply because it moves, I find, in a very random way. And I think oil is kind of the more better gauge on what's going on in the energy space, and it's a more controlled kind of position to be in.
Interestingly, mining equities are holding firm. While metals consolidate, many large-cap producers remain near recent highs. Fundamentally, elevated gold prices improve margins, making miners appear undervalued relative to bullion. Investors often rotate into these equities seeking leverage to metal prices. However, mining shares, silver and gold, frequently move together. They are variations of the same macro trade. Differences lie mainly in volatility and performance intensity. Gold typically attracts defensive capital during uncertainty, while silver behaves more speculatively. If confidence returns to the sector, miners could outperform, but they remain sensitive to broader market direction.
Well, if we see eventually the markets and the economy kind of struggle, I think we'll eventually see a very big pullback in oil. I think we could see oil break a very significant level. There's let me just get a line across here. So there's this kind of significant pivot level right through the charts here. And I think if this $55, $56 per barrel is broken, I think we could see oil very easily come on down to about $45 per barrel. That's a fairly significant level. If we can just kind of box this kind of range in a little bit. This 40, 43, $46 per barrel level is a very significant level for a few reasons. It is a measured move to the downside, so that's naturally where the markets, I think, are going to flush down to once this support level here is broken. But it's also a very significant pivot low from 2018. It was a big breakdown level where oil had a huge gap and then crashed. It's also a very significant pivot high in 2020. And then, of course, it traded through here some more, which creates more of resistance. So I think that could be eventually, I think we could see this, break down and sell lower. And of course, if the stock market is trading lower a year from, by the end of this year, we'll probably see oil also trading lower. It's going to probably mean business is slowing. People are tightening up on their spending, their travel, products, and all of that stuff. So oil will definitely, I think, get hit at some point. So I'm bearish on the equities market and oil at this point, but not betting on falling prices yet. We have to let a lot more damage happen on the equities market and oil before we want to bet on falling prices.
Outside precious metals, energy markets present a contrasting narrative. Oil remains in a broader downtrend despite periodic rallies. Short-term rebounds may occur, especially toward the low $70 range, yet structural weakness persists unless geopolitical shocks intervene. Should economic growth slow, oil could revisit major support levels near the mid-$40 range, areas that previously marked significant pivots. Natural gas, meanwhile, remains highly volatile and less predictable. Historically, falling oil prices often signal weakening demand expectations. If equity markets decline meaningfully, energy commodities may follow, reflecting broader economic contraction rather than inflationary pressure.
The peak in precious metals or the peak in the equities market?
In gold.
I think there's a good possibility that, because what we saw here, if I zoom in on this, 2008, we saw precious metals explode higher. So if the stock market, for example, starts to sell off right here, we could see gold and silver have a very strong push up, and while the stock market starts to break down. As you and I talked about, the NASDAQ is on the verge of breaking down. So we could see the NASDAQ actually start to break down, and we see gold and silver rally temporarily. Eventually, as the stock market keeps selling off, I think it'll pull metals down with it. So I think we just need to give it some time to see if the stock market breaks down and if the money from stocks flows into precious metals or not. I do have an interesting chart here of silver comparing the 2011 type of scenario. If we look at this is silver right here. There's another bar, so since I've pasted this, but we had this big run up and these pauses and rallies and pauses and this huge reversal just over the past couple of months. And 2011, the price action leading up was almost the same, and then it had a big pullback. Both of them were 30+% pullback. And then the market kind of drifted higher. And this is what I'm talking about. These were inside bars on the silver chart, this big red bar. All of this just was the market walking back up to the upper range of this bar. And then it sold off. And then we went into a decade-long correction. And so we could easily see that with silver and gold. And then it sells off. And when we look at what happened to gold and silver back in this time, you can see here, there was a very long time before, gold really took off. It went from 2011 all the way to 2014 before it really actually broke out and started to generate returns. So, that is a long time. It's, 12 years or so of no return. Silver did much of the same thing. And so that's what I want to be aware of. Like, are we at a 2011 type of peak where precious metals might have one more push up before pulling back? Or, are we at did we just have another end of a cycle, and now we're going to see precious metals kind of flounder? That's what we need to kind of wait and see unfold here.
Yes. If we could look at uranium, Chris, how is uranium looking from the technical perspective?
Yeah, I mean, I have URA here as an ETF to kind of look at it. It's been out of favor forever. It's built a bottom and a launch pad, and now it's in a strong bullish environment. When we look at it, it has a very similar chart pattern as silver does, which is the long-term trend is up, but the short-term trend is down, and it's kind of struggling, trying to figure out what it's going to do. It needs to build a base. It needs to start to like break out and start to move up. Something kind of like this, right? It builds a base, and then eventually it breaks out it, and then it could make another run. So the question is, how big is this base? Are we going to come down, or are we going to start to break out sooner or later? So this is the problem with the market. Almost all assets, when it comes to equities or commodities, is they've all had this similar price action. The long-term trends are up, but the short-term trends have done a lot of damage, and they're, trying to figure out what they're going to do. And I'll just pull up the chart of silver real quick, just because it's, so many people have been following it and trading it and experiencing the euphoric kind of run up here. But silver is trying to figure out, what it is going to do. And silver could, from these lows, just like we saw in 2011, it only ran about 33% or so from the lows, and then it sold off, and it took 10 plus years to recover. So that's what we need to be aware of. And the long-term trend of silver is up, but the short-term trend is still struggling. And uranium is in that same space. If you'll notice pretty much all the commodity resource stocks have done the same thing. They all have one of these big red bars and almost the same volatility. It's the same group of people, right? Trading most of these. So when they're all scared, they all sell. When they're all excited, they all buy. And you could overlay all these charts and they pretty much mirror each other. Just some have bigger bounces and sell-offs than the other, but it's the same people, just with big waves of buying and selling at the same time.
Across commodities and resource equities, a common pattern has emerged: strong long-term trends paired with damaged short-term structures. Uranium, silver, gold miners, and broader resource stocks display similar volatility spikes and consolidation phases. Much of this behavior reflects synchronized investor psychology. When fear rises, assets sell together. When optimism returns, they rally in unison. The key question now is whether capital-fleeing equities will rotate into precious metals, as seen during past financial stress periods like 2008. Confirmation through decisive breakouts will provide clarity. Until then, disciplined patience remains the most strategic position.